Hello everyone, I'm John Cunnison. I'm the Chief Investment Officer at Baker Boyer Bank, and I want to welcome you all to the monthly market update. Today we're going to be talking about AI, so a subject that I know is on the minds of all of you and on the minds of investors around the world. I want to begin with a quote. It's from a legendary investor. He ran Fidelity's Magellan Fund for many decades, Peter Lynch, and his quote was, "More money has been lost by investors preparing for corrections than in the corrections themselves." I begin with this quote because I think the question that I'm getting more often from my clients is AI a bubble? Is the stock market in a bubble currently? And is there anything that I should be doing to prepare right now in my portfolio? Now, behind this question, I think is a very thoughtful and I think a correct observation. And that is that the best predictor of future expected stock returns is the current price. Another way to say this is high stock prices today simply tend to predict lower expected returns in the future. If you buy something at a low price, well, it's nice to buy something less than it's worth, and your future expected returns are going to be higher, right? So apply that to the current situation, and if we say it in real crude terms, if I'm buying these, AI stocks at nosebleed prices, should I be getting out while the getting's good, right? And that's ultimately what the question is. Now, the trouble with this is, although current prices are the best predictor of future expected returns, they're not a very good timing vehicle, right? So I can show you charts that would explain the relationship between current prices and future expected 5-year returns or 10-year returns, and you'd see a very close relationship, right? The lower the price, the higher the future expected return. However, if I show you a 1-year chart, right? Current prices today, and what does that tell us about returns 1 year from today? It's almost nothing. And so we have to be very, very careful about trying to predict the future and predict future expected returns. If we look at the experience of the tech bubble and bust and ask the question, was anyone able to predict when that tech bubble and bust occurred? And I'll go back again to Peter Lynch. Peter Lynch said investors should be more fearful. Other famous investors, including Ray Dalio, the founder of Bridgewater, very famous investor, Howard Marks, who's a pioneering investor in distressed debt. These are all very, very smart investors. And all of them are on record predicting the tech bubble and bust in the year 2000. Now, the problem is they made all of these predictions in 1995. The bubble didn't burst until March of 2000, right? So there was a 5-year period. And in that 5-year period, the market, at least the NASDAQ, so the tech-heavy NASDAQ, it was up over 1,000%, right? So going back to that quote from Peter Lynch, right, it can be very, very costly to prepare for a correction as opposed to simply making small adjustments in your portfolio, knowing that prices are becoming elevated. The bottom line is that because we cannot, and this is something we've said in these videos many times before, but because we cannot predict, we have to prepare, right? So what can we do in our portfolios? And before I get into things that we can do directly in our portfolios, I want to talk for just a moment about AI as an investment theme. Now remember that although I'm talking about how AI stocks are currently exhibiting very high prices, right? And I'm talking about that currently as if that might be a problem, right? And it is something we should pay attention to. But the reason that those prices are so high is that AI is a very, very exciting technology. Right? It's a technology that has the potential to raise productivity in every industry throughout the economy. Now, there's a word for that. It's a GPT, and this is a different GPT than ChatGPT. It stands for general purpose technology. And a general purpose technology is one that infuses throughout the economy and raises productivity levels. Now, the reason this is important is because the holy grail for growth, especially in advanced economies, is productivity. And the reason I say that is because we don't necessarily want to just grow the output of the economy. We want to grow the output per person. That's what productivity is. And AI is very, I think, uniquely positioned to potentially increase productivity across the economy in every industry. So if some of the lofty promises of AI are fulfilled, it makes us better prepared to handle some of the economic challenges that we know we face in the future, including an aging population and increasing government debt. To handle that debt burden that currently looms over the generations that are going to have to work to handle it. Right? In order to handle that debt burden, what we need is economic growth. And AI promises to sort of make that debt burden easier to manage. Right? So there are good reasons for investors to be very excited about AI. Now, the problem that we face as investors is, and here I'll again look back to the tech bubble and bust, I'm not sure which stock is going to be Netscape. And for you younger investors, that was a browser that no longer exists today. I don't know which stocks are going to be Netscape and which will be Google. That is, I don't know which ones will survive to be the stocks that really profit from AI and those that won't survive this period of, bubble and bust. So what do we do in our portfolios? Well, what I would argue is that we don't make any dramatic moves. Right? We should make changes at the margin, and that's what we're doing in Baker Boyer portfolios. So if we just simply look at the stocks, the stock portion of our portfolios, well, one thing that we can do is we can simply lean out of the most expensive stocks and into some of the stocks that have lower prices. Right? We can do that within the U.S. market. There's a lot of really wonderful companies that don't exhibit the prices that concern us most. Now, the other thing that we can do is, because AI is largely a U.S. phenomenon, there's a lot of international stocks that don't have those incredibly high prices and that have very attractive future expected returns, right? So we can simply diversify internationally. Now, in Baker Boyer portfolios, we've done that. And this year in particular, we were rewarded for that. International returns were very, very high. Close to 30%. Now, the other area of the market that we can look to is the bond market. So we look at bonds, whether we're looking at government debt or we're looking at corporate debt. In the bond market, we see attractive yields. Right? And what's an attractive yield? Well, at the baseline, an attractive yield is one that's above inflation. And so if inflation is running today at 3 or just under 3, we're getting yields on U.S. government debt that's 4% for a 10-year Treasury bond, higher for slightly longer. And in the corporate market, we're getting higher than that, 5, 6, 7%. In the municipal bond market, for people who are in the highest tax brackets, we're getting tax equivalent yields that are above 5 and 6%. So right now, bonds are an effective way to diversify a portfolio and hedge against potential stock market volatility. Now, the final area would be real assets. And real assets include real estate, infrastructure, things that generate fees like airports, toll roads, pipelines, commodities, so natural resource stocks and direct commodity exposure, and even gold, right? And those are all things that we build into some portion of the portfolios that we're building here. And again, going back to I think some very wise advice, which is we need to prepare because we cannot predict. So we build these diversified portfolios that are positioned for whatever markets deliver. With that, I'll wrap things up. If any of you have any questions about anything I discussed today, please reach out to a member of your Baker Boyer team. And with that, I wish you all a happy holiday season and the best of investing in 2026.